Um, Last week, I think it was Christy who asked if I could give StockTrack another try, and so I'll give it a go this morning and see if it'll take my order. I'm still paying the price for not having shorted those bonds last week. Here you go. Here's a hand up. So hopefully by now you're all registered with StockTrack, and I'd like you to start trading, immediately in the next few days. Once you register, you'll have your password. The account number is on the website, and then you go up to make a trade and click on that. It asks for your account number, your password, and then it gives you 4 options here. And initially, you have no position, so either you have to buy or go long to open a position, or short to open a position. So you can't close a position if you don't have one yet. So if we click on, let's say, buy to go open, number of contracts, I'll choose 1 contract. You put in the number. Categories, this is where I had trouble last time. Let me check interest rate futures. And then it should allow me to select. And I'll take D03 Treasury bonds. So I've clicked on buy to open, go long, 1 contract, Treasury bond, futures December 03, and it says send your trade request. Okay, you must click on place order.
It was on that page.
Oh, it was on that page?
Yeah.
Oh, great. Oh, it wiped that out. Okay, so you can just confirm your order. My account number, the type of order, it's BFO, buy futures to open 1 contract. It gives a ticker symbol. Every contract has a different ticker symbol, and you can find those symbols on the StockTrack webpage. This happens to be US, which stands for Treasury bonds. That's the code. Z stands for December, and 3 stands for 2003. So 1 T-bond, December 03. It also gives you the exchange, Chicago Board of Trade. There's the price, 109, and then you click on place order. And it's been confirmed. Now what you should do when you send it in is type your email address in here, and it will send you a confirmation. And that way you have a record of having placed the order. Okay? Now, Christy, you had some questions.
I understood how to do that.
Okay.
I would like to go over looking at the sheet you just passed out maybe.
Yeah, that's my intention.
Okay, and
Yeah.
how you decided to purchase the December versus the next one.
Okay. Well, I'm just angry because I didn't sell last week. So the bonds have crashed over the last 3 or 4 trading days, and I'm hopeful that maybe it will come back. I chose December because it has a large trading volume, and so probably the price I get will be close to what was quoted to me on the screen. So if you have an active market, it's a little easier to get it filled. Of course, with StockTrack, it doesn't really matter, but in the real world, you want to choose a contract that has sufficient volume that allows you to fill your order. Okay.
And if we wanted to see a graph maybe of the yearly prices,
Mm-hmm.
we go to one of those other websites or other stuff?
The best source is the Wall Street Journal. If you go to the commodities page on the Wall Street Journal, and then you get a price quote over on the left-hand side of each quote, there's a little graph symbol. You click on that graphic, and a graph pops up. Okay? I can just show you really quickly. Are there any other questions on placing the order on StockTrack? Any questions on StockTrack? Yes?
When I went, it asked me to put in a ticker number, and I didn't understand where to put it. It didn't do it. What happened up here?
Okay, so it asked you for a ticker symbol?
Yes.
Yeah, I don't know. I mean, normally you choose the category. I chose interest rates, and then in plain English it says December 03 Treasury bonds.
Right.
But the ticker symbols are all on stock track. If I forget exactly where you can find them, but I think they're down over on the left-hand side, down towards the bottom somewhere. So as I said, U.S. Treasury bonds is just U.S. And then the other symbols, like the month and the year, are common to all contracts. Z is December, 03 is the year. Okay. If you're still having trouble, either send me an email or I'm on Tisha, or perhaps you could come by my office and we could try it there. Okay. Any other questions on stock track? I mean, you really have to take the initiative yourself and look at the rules and look at the stock track page. There's a lot of information there. Yes?
Once you buy a contract, can you go back and see what the specifications are of this? Or where do you go to check?
You can check your account number. You can click on account detail. Put in your password and account number, and it'll give you a record of your transactions. Okay? And the price that you bought or sold at and so on. But if you want more detail on the actual contract, then you have to go to the exchange website, whether it's Chicago Board of Trade or whatever. Okay? So we're now at the Wall Street. We're not at the Wall Street Journal. We're at the New York Times. I'll just show you quickly how to find those graphs, Christy. Okay, so we're at the Wall Street Journal. We want to go over here and select markets, and then go down to commodities, okay? So there's the story in today's journal about crude oil. It's starting to make a comeback. If you go down to the bottom, it has market data and resources. So if we click on interest rates to check the T-bonds, then it gives you options up here, okay? I'll go down and find US T-bonds. There's the current price. December is 108.31. Over here, if you click on this symbol, whoops, hang on, wrong one. That'll give you the graph, okay? That's the best source that I know of because they're updated every 15 minutes or so. Okay? In fact, you can, that's the action this morning. So if you click on ticker, this is East Coast time, but you can see where the market's been trading over a 5-minute interval. Again, that's prices today, so you can actually see what the market's doing today, which is really handy. That's a 5-minute interval, and these are prices at 15-minute intervals. So it's extremely helpful in terms of giving you an idea of where the markets are today. Okay. So I mentioned the quiz. I don't know if you've been checking the Iowa market, but the recent news on Arnold knocked his price down slightly, but I see it's back up today. The election's tomorrow, so according to the market, he's going to win tomorrow, and we'll have a new governor. Okay, let me give you a very brief rundown on the history of these markets before we turn to the Wall Street Journal handout that I gave you today. So I've mentioned that the markets as we know them today in the U.S. are about 150 years old, but actually there was trading in Europe and in Asia with very similar contracts earlier on, but then they died out. Basically, these were forward contracts that, for whatever reason, ended up being traded on an exchange. In those days, they were trading grains, which was largely rice in Japan. There were markets in Europe that traded whale oil, brandy, and coffee. These were the markets in Amsterdam. The market in Japan in the 18th century in a way started for the same reasons that the Chicago market started 150 years ago. Back then in Japan, the landlords who owned the farmland tended not to live there. They tended to live in the city, and they had all these tenant farmers that were producing the rice, and it was pretty much a crop share basis whereby the landlord obtained a share of the crop as rent. These landlords had very lavish lifestyles in the city, and of course the harvest is only once a year, so when they would receive their harvest, they would sell the rice and then spend the money, having a good time. But some of the landlords ran out of money before the next harvest, and what they started to do was to issue basically a promissory note, a piece of paper that says, I agree to deliver so much rice in a certain month at some future time period. And so they would sell that promissory note for cash. And then they had their money. The person holding the promissory note would collect once the harvest was in. And it wasn't long before these promissory notes started changing hands and a market developed with forward pricing for rice. It died out later on, but at least the history books tell us there was a predecessor to the Chicago Board of Trade. Chicago Board of Trade was set up for, in a way, similar reasons. Back in the 1830s, 1840s, there was an economic and technological revolution going on. It's called the Industrial Revolution. That really started in England. And as a result of the Industrial Revolution, some European countries lowered their import tariffs on grain and started importing more grain and other commodities from the New World, from America. And in addition, the Industrial Revolution resulted in significant improvements in transportation. You know, we had the steam engine, the steamship, and so on. So this was a time period when America was really being settled. Land was plowed. There was bountiful harvests, so much so that the U.S. started exporting grain primarily to Europe. A lot of the exports in those days were run through the city of Chicago. That was conveniently located on the Great Lakes, and there was a river system that would help bring the grain into Chicago. What happened in those days, of course, after the harvest, every grower, every farmer delivered their product. And so immediately after the harvest, everyone was trying to sell. The price was depressed. There was insufficient storage capacity to carry the inventory throughout the year. So you had these large seasonal price swings, as this graph shows. This would be harvest in year one. This would be harvest in year two. So immediately after the harvest, you had a fall in price because of a surplus grain. Some of the grain went spoiled on the streets outside the warehouses. They didn't have room for the grain. And then, of course, prior to the next harvest, they ran out, typically, and there was a shortage and a very high price. So this was an inefficient market. And then what happened was basically some entrepreneurs from Chicago started traveling into the countryside and buying promissory notes from farmers. So basically they encouraged the producers to store the grain, not to bring it into the market, and they promised to buy it then at some later date. Let's suppose the harvest is in October. They said, you keep your grain until January, you bring it into the city in January, and I will pay you so much per bushel at that point in time. So the net effect of these types of forward contracts was to remove grain from the market immediately after harvest, so everyone wasn't trying to sell at the same time. So the price didn't fall by as much. And then during the course of the marketing year, this grain slowly was led onto the market. And so prices did rise, but not as dramatic. We didn't have these large seasonal price swings. And in addition, the owners of the warehouses now had a way to lock in a price through these forward contracts. So it also encouraged storage. So additional storage facilities were built. So prior to the introduction of these forward contracts, the seasonal price behavior was something like what is shown by these green lines. Low price rises rapidly to the next harvest. And then, of course, when the next harvest comes on, the price drops dramatically, and we start all over again. The net effect of the forward contracts was to take grain off the market. This raised the price at harvest time. It was slowly sold onto the market, and we didn't have such a large price increase prior to the next harvest because some grain was actually carried from one year to the next. So this was really the beginnings of the Chicago Board of Trade, these forward contracts. It wasn't long before these merchants who went into the country to procure the contracts, they started selling these promissory notes, these contracts, in a secondary market to raise capital. So you might have a merchant that goes out and he buys grain on a forward basis from 100 growers. He would not have capital to advance an initial price to these growers. So then he would turn around and sell some of these promissory notes. So the city of Chicago realized that this was serving an important function. It improved the efficiency of the market. It reduced the wild seasonal price swings. So the city set up a gathering place where these merchants could come and trade these forward contracts. And that was really the start of the Chicago Board of Trade. Then the next step, of course, was to introduce futures contracts, which simply standardized these forward contracts. Each of the forward contracts was different. It might be a different volume of grain. It might be a different delivery period. It might be a different grade of grain. And so what the Chicago Board of Trade did was standardized the contracts which facilitated trading, basically. It facilitated trading among the third parties, those with capital that were interested in buying these promissory notes in the anticipation of taking delivery of the grain and then selling it for a higher price as the season progressed. So as a result of the introduction of these forward and then futures prices, you saw seasonal price swings reduced. There was still an upward movement, but it was more according to the cost of storage. You'd expect in a storable market the price to rise by the cost of storage. And of course the green lines depict price rises that are much greater than the cost of storage. And so we saw prices rising by the cost of storage along this white line, for example. So that was how it started. The city endorsed this market. The contracts became standardized, and the first one was wheat, and then soon it spread to corn, soybeans, and a host of other agricultural commodities. Okay? And again, the basic rationale for introducing the futures market was to eliminate this very inefficient price behavior in the marketplace. Okay. Any questions on that? Okay, let's turn to the handout I gave you then. We'll spend some time on that. This handout was taken from Friday's Wall Street Journal. And I'd just like to go through some of the price quotes here. Let me bring up one from today. Okay, on the screen I brought up the price quotation on the electronic version of the Wall Street Journal. It's very similar to what we see on the paper here. So clearly this is a newspaper, so there's a one-day lag. So the prices reported on Friday were those from Thursday's market activity. Okay, in today's Wall Street Journal we would have Friday's. Up in the top left-hand corner, you see the exchange abbreviations. This tells you which market the particular contracts are traded on. Okay? Does everyone have a piece of paper? Okay. So we have Chicago Board of Trade, the Merck, Coffee, Sugar, and Cocoa Exchange, and so on. The reporting is very similar from contract to contract, so I'd just like to walk you through a few of these contracts. So let's start with the left-hand side, and you'll see, first of all, the date is above the heading that says Grain and Oilseed Futures, Thursday, October 2nd. So this was the price behavior on October 2nd, reported on October 3rd in the Wall Street Journal. Then our first contract you see is corn. Left-hand top corner. Corn in brackets, it says CBT, that stands for the exchange. Then it says 5,000 bushels, that's the unit of exchange, the size of the contract. And then it has cents per bushel. So the price quotes are in cents per bushel. Very similar to what you see on the electronic version. You have the contract, you have the delivery month, the last price, the change in price, and open, high, low. The opening price this morning, the high price this morning, and the low price this morning. And it has volume and open interest, which I'll explain in a second. So if we go back to the paper version, we have corn. So let's just pick the first row in that corn market, which is December 03. It doesn't put the date in there because it's a nearby one, and it would only report the year if it's a different year from the current date. So we see December, so that's December 03. The next contract is March, that's 04. Then we go to May, July, September, and December 04. So in the case of corn, there's still sufficient volume even in a market for delivery in 1 year's time. So back up to the top of corn, we have December 03. Then each column represents activity in the marketplace. So the first column of prices is the opening price. So on October 2nd, corn opened, the December contract opened at $2.20 a bushel, or 220 cents per bushel. The contract size is 5,000 bushels, so roughly speaking, that's about $11,000 for the total contract value. It opened at 220. The high price was 223.50. That was the high on that particular day, which means there was at least one transaction where there was a buyer and a seller at 223.50. The low was 220, and the settlement was 220 and a quarter. So the price at the end of the day settled at $2.20 and a quarter. As I mentioned last week, that settlement price is extremely important because that's the price that the clearinghouse uses to bring every open position to market. So the settlement was 220 and a quarter. In the change column, it shows nothing. I assume that means it settled at the same price the previous day, or maybe the Wall Street just didn't record it. I don't know. Then the next two columns, it says lifetime high-low. So that's the lifetime for that particular contract. So for the December 03 contract, from the time it was first listed, so that would have been over a year ago, from the time it was first listed on the exchange, the price traded as high as $2.69 a bushel and as low as $209.50. We don't know exactly when that was. You'd have to go to a graph to find out, but that gives you some idea of the price range for that contract. And then we have the open interest, and that number is 226,968. We also have the open interest on the electronic version. Now we see it's 226,209, so open interest has fallen in the case of December corn, which is not surprising because we're getting close. That's a nearby contract. Open interest refers to the number of outstanding positions that have not yet been liquidated. It's a cumulative concept. So if each contract was tied to one trader, let's suppose that traders only hold one contract. If that's the case, then there would be 226,000 longs who have opened a position and haven't reversed them, and 226,000 shorts. They've opened a position, hasn't been reversed. Of course, we know that some traders will have more than one contract, but this is the number of outstanding contracts. So if you buy a contract, somebody sells it, and you're just entering the market and they're just entering the market, well, that will be an additional open interest. If you're buying a contract and the person selling it to you had previously bought, so they're reversing their position, they're getting out, you're buying, you're getting in, then open interest would remain unchanged because you're simply replacing that trader in the market. If I buy today, and suppose I had been short, so I sold 3 months ago and I'm buying today, I reverse my position, and the trader that sells to me was previously long, so they're also reversing their position. So I'm getting out of the market, that trader's getting out of the market. If we execute a trade together, then open interest would fall by 1, holding everything else constant. Okay? The open interest starts at 0, rises just before expiry, and then has to go back to 0. If you look on that open interest column for corn, you see as we get more distant, the open interest tends to go down, which means that for some of those contracts, the number of outstanding longs and shorts falls because these are distant contracts. That number for March 04 will rise as we unwind the December contract. Okay, this is a good time to ask a question if you don't quite understand how to read this page. Because on the exam, sometimes I have a habit of just giving you a section of this page. And then I'll ask you questions about different contracts. And you have to be able to read the page and understand the size of the contract for euro, dollars, or T-bonds, how the prices are recorded. I'm assuming that you know how to read this when it comes to the exam time. Yes?
Could you go further in the future past December 2004?
It's quite possible. The question is, could you go past December 04? The Wall Street Journal doesn't report all of the open contracts simply to save themselves some space. They report the ones where there's pretty high volume. So the answer is yes, but how far into the future? Probably not that much further. But if you do look at crude oil, and we looked at that last week, more or less in the center of the page there, you'll see that it goes up to December 06, and then I snipped it off. It actually goes, I think you can trade crude oil 7 years or something into the future. So it varies by contract, and it's really a question of whether there are willing buyers and sellers that want to trade a contract that doesn't expire for several years. If there are willing buyers and sellers that want to trade it, the exchange is happy to list it. They only put up a contract when there's interest in trading it. Yes, the question in the back. Yeah. Pardon me? The Treasury bonds are in points. Was that your question? Okay. Okay. So the question is, we're looking at Treasury bonds now. How do we interpret those prices? Let me just turn on some lights here. So if we look at December 03 T-bonds, okay, so that's the contract that I just purchased this morning. You have a settlement price of 111, 110, I'm sorry. No, 111.10. Okay? That's the settlement price. And I think the price that I was showing this morning was 109. So that was the price on Thursday. So as we look here at the Wall Street Journal, it says Treasury bond, Chicago Board of Trade. Is everybody with me? We're in the center here. $100,000. That's the size of the contract. $100,000. In other words, it's a $100,000 bond, and it's points of 100%. Okay, points, 30 seconds of 100%. So in other words, if the price was at 100, then this T-bond contract would be trading exactly at par value. So the Treasury bonds are standardized like the other contracts. So it's actually a deliverable contract. So I just bought one this morning, right, for 109, whatever I paid. Let's suppose I bought it on Thursday for 111.10. So what that means is I'm agreeing to take delivery of a U.S. Treasury bond in the month of December. And if you look at the contract specs at the Chicago Board of Trade, you'll find that the contract is written on a $100,000 bond, 15 years to maturity, and paying 6% interest. Okay? So if prevailing long-term interest rates are below 6%, which they are now, it will trade for more than its par value. If long-term interest rates were right on the nose, right at 6%, then this contract would trade at 100. So there's this inverse relationship between bonds and interest rates, which you may have seen in other classes. And I'll talk about this when we get into Chapter 4. But to answer your question, each of these points is worth $31.25. Okay? Because if you multiply 32 by 31.25, that gives you $1,000. Okay? And this is a percent of par, so it's trading above par value because interest rates are below 6%. If the price was exactly par, it was 100, then its value would be $100,000. So we're talking about a percentage here. So this bond has a value of $111,000 and 300, okay, because it's 10 times 31.25. So the value would be $111,312. That would be the total value of that contract. Now, why are they quoted in 30 seconds? That's the convention in the Treasury bond market. It's the same with cash prices. That's just the way they quote the price. Like in corn, it's dollars per bushel. Here, it's a percent of par value. Does that answer your question? Or? Okay. Yes?
I'm confused. It says opened at 111.30 and then settled at 111.10.
Mm-hmm.
How does that equal a change of -24?
Okay. So the question is, how does the difference between the opening and closing equal a difference of 24? Okay. So first of all, the change, it shows a minus 24. So that's 24/30 seconds, right? That's how much the price has changed. And that equals $750. So that price change is from the previous day's close. And that's true for all these contracts, okay? So it closed at 111.10, and so it was down. The price fell by 24/30 seconds from the previous settlement price. So I mentioned the settlement prices are critical because that's what the exchange uses to market all the contracts. So, yes?
So the open of that day is not necessarily the close of the day before?
Correct. Question is, the opening of the day is not necessarily the close of the day before. Absolutely correct. A lot of information comes in the market overnight. We have overnight trading for most of these contracts. And so the settlement the day before, that's where the market was when it closed in Chicago at whenever it closes, 1:30 or 2 o'clock in the afternoon. And then the opening price is the price at which there's an initial trade. Again, it requires a buyer and a seller the next morning. So it can be up, down, or the same. Now, there are certain limits on the extent to which a price can move in certain commodities. The regulatory agency that oversees futures trading place limits on the extent to which a price can change from one day to the next, basically to protect others that are in the marketplace. And I'll go over that later when we talk about the clearinghouse and the CFTC, which is the regulatory agency. Christy. Yeah.
Back to the open interest number. I know that it's high right now for December contract. Like the day that it closes, would that number be significantly lower, or is it going to get as tight?
You mean when the contract expires? Okay. So the question is the open interest, and were you talking corn? Or probably doesn't matter. Okay. The open interest on December corn, you see, is 226,968. So tell me again what that means.
That's how many open contracts there are right now.
Okay. Open, long, shorts, or some of the two, or? Either or, because for every open short, there has to be an open long. So you don't add the two together. You take either the number of open longs or the number of open shorts. So there's over 226,000. That contract will expire towards the end of December. And I don't remember the exact date, but let's suppose it's December 22nd. So December 22nd, that contract goes off the board. It's finished. So at the end of business that day, open interest has to be zero. Everybody has to get out. So the easiest way to get out, of course, is to reverse your trade. Or if you've sold and you don't reverse your trade, then you must deliver. And if you're long and you don't reverse your trade, then you must accept delivery, in the case of corn, because it's a deliverable. So it's either settled by reversing your trade or by delivering or accepting delivery. So if you're still holding an open short and it's 2 days before expiry, you'll get a call from your broker saying, what are you doing here? What are you going to do? Do you have corn in storage in Chicago to deliver? And if the answer is no, well, then you better reverse, or you better buy some corn and deliver. But that's not a problem, because on any given day, there is a lot of corn in storage at these delivery locations. And so you could actually buy some physical corn and deliver if you wanted to. I don't know why you would do that, but some commercial firms will deliver because they happen to have corn that's in storage, or it's very close proximity. They can put it into a deliverable position, and sometimes they will deliver. Yes?
So the relationship between these forward contracts and the actual commodity.
Yes.
Before you can say it wasn't necessarily one-to-one relationship.
Correct.
So how does that get reconciled?
Okay. So the question is, last week I mentioned that for every bushel of corn produced, there could be 4 or 5 traded on the futures market. So her question is, how does that get reconciled then as we approach the delivery day? In other words, if there's only 10,000 bushels of corn in delivery and you've got 5,000 open interest, I mean, how can they possibly work? Well, the government regulatory agency and the exchanges keep a very close watch on what they call deliverable inventories for a commodity like this. And if the open interest, as we approach December, greatly exceeds the volume of physical inventory, then they will monitor it closely, and they will encourage traders to either liquidate their positions or move more product into a deliverable position. In other words, they're trying to prevent what's known in the trade as a market squeeze, where there simply isn't sufficient volume in deliverable position to honor the contracts. And of course, if you're long, that's a good situation, because if you're long corn and we don't have enough corn to deliver, then the people that are short, they're going to be trying to buy futures, right? And they're going to come to you in the trading pit, and they're going to be trying to buy from you. And you're just going to go away and have a cup of coffee, because you know full well that there isn't sufficient corn. They can't buy the physical inventory. They have to buy it back from you. So then the price is just going to spike up dramatically. And that has happened periodically over the history of the Chicago markets. Not very often, and it happens much less now than it used to because we're more sophisticated with data, with computers and everything. So the answer to your question is yes, it's a possibility, but the exchange and the government does everything it possibly can to prevent that from happening. And if they can show that traders are intentionally trying to put a squeeze on the market, then they will take action. More recently, this has happened in London a few times in the metals market. Similar idea where there's only so much silver that's in a deliverable position, and if people can put a squeeze on the market, they can drive the price up. All right. Let's look at the euro over on the right-hand side. The article that I sent you over the weekend, I thought I brought it with me, but maybe I didn't. I forgot to bring it. Anyway, I sent you an article over the weekend out of the Wall Street Journal that basically was reporting on what happened last week with this positive earnings report. The reason the bonds crashed was there was a positive report coming out that says that the unemployment rate is not as high as what was being predicted. In other words, jobs are being created in this economy. So that sent bond prices down. It sent the dollar up, and it sent the price of gold down. And that was all discussed in that one article. So it's really important you read that, not only because it might be on the quiz, but to help you understand how these markets are linked. Basically, it restored some confidence in the potential growth in the U.S. economy. So that sent the dollar up, price of gold down. The only reason gold has been rising is because the dollar's been falling, okay? And it sent interest rates back up. So the market activity in the currencies today is very topical. So let's just look at the euro. Over on the right-hand side, about a third of the way down. You see, I drew an arrow there. It says euros per US dollar, CME, Chicago Mercantile Exchange. Then it has the size of the contract, 125,000 euro. It's the size of the contract. And then the price quote is dollars per euro. This is particularly important. If you look at all of the currencies, starting with the Canadian dollar, the British pound, etc., the price quotes are always dollars per foreign currency. Sometimes in the newspaper you'll see it the other way around. This is just the inverse. This is always dollars per foreign currency. So we see on the euro, the price opened at 117 and it settled at 116.67 on the DEES contract, and so it was down. So that $1.16, that's dollars per euro. If we multiply that by the size of the contract, right, that will give us the total value, because it's $1.16 per euro. If we multiply that by 125,000 euros, right, well then the euros will cancel, and we'll get the dollar amount, which is about $145,000. So that's the approximate value of that contract. Because it's dollars per euro, if the dollar gets stronger, that price falls. So you must understand that as well. And again, trading stock track is really going to help you in the quizzes, because I'll ask you questions about the euro or the Treasury bond. In the first few exams, I'll ask you to calculate some profits or losses based on certain price changes. So you really have to become familiar with the contracts that I tend to use as examples. So my favorite ones are Treasury bonds, euro, perhaps gold, or one of the agricultural commodities, which are a little easier to understand. So let's just drop down a little ways in that column into the index futures. I know some of you have expressed an interest in trading those. Does anybody know, does Stock Track let you trade the mini S&P 500? I haven't checked that out, but if you're really interested in trading the S&P, you might look at the mini 500 because I didn't give you enough funds to trade. I think maybe you can only trade one S&P 500. You see the S&P 500 index, Chicago Mercantile Exchange, $250 times the index. And right now the index is just over 1,000. So that price quote, it says December settled at 101960. There should be 2 decimal points in there. And again, the Wall Street Journal does that just to save ink. They don't bother with the decimal points. So we all know that the S&P is not at 100,000, right? It's at just over 1,000. So you take that price. Let's say if we took 1,000 times $250, that's $250,000 is the value of the contract. So this contract has a large value, and a small price change will wipe you guys out or make you very rich over the next few weeks. The mini, you see, is only $50 times the index. So it's 1/5 of the value. So that's more like a $50,000 value contract. And of course, you can trade the Dow Jones if you want up on top. It's $10 times the index. So that contract value is just under 100,000 because the Dow is at about 9,500. Here it says December is 94.67. You multiply it by 10, that gives you the value of the contract. And as the Dow moves up or down, the total value will go up or down, and your profits or losses will go up and down. So the change in price is just the change in index times $10. Let's just look at the euro dollar before I let you go. Euro dollar, center of the page, near the bottom. Again, I'll just repeat myself. This is not euros. This is the interest rate future. It's euro dollars. It's traded on the CME. The face value is $1 million, and the price quote is points of 100%. So it's different than the T bonds. And we'll go over this a bit when we're in chapter 4 as well. But if you start trading the euro dollars, you'll see that those price quotes are 100 minus the interest rate. So the quote is 100 minus the interest rate. Okay? So that's an October contract up on top, the top row. The price settled at 98.86. 100 minus 98.86 is 1.14. It actually gives you the yield here. The Wall Street Journal actually gives you the yield. So if the yield is 1.14, 100 minus 1.14 will give you the price of 98.86. Okay? Each of these points is worth $25. So if it goes from 1.14 to 1.24, so if it goes from 1.14 to 1.24, that's 10 points times $25 or $250. That's how you calculate your profit or loss. If you want to read ahead because you want to trade euro dollars, have a look in chapter 4. Same goes for Treasury bonds. Okay, I'll see you on Wednesday.